Good morning, students. Welcome back to the session on this auditing standard. Today, we'll continue with our discussion related to the standard on CAM. In the last session, we discussed about understanding of CAM primarily and certain criteria in respect of CAM, which get generated from the meaning of the CAM itself, which is given in the auditing standard. So today, we plan to continue with that. And we'll also get into more details as around the assessment of CAM and what are those criteria which are given in the auditing standard using which CAM has to be CAM needs to be determined. Further, in respect of CAM, as we discussed, that it is completely judgmental. So even though there are certain criteria which are prescribed in respect of determining CAM for a company, still it's something which depends on the judgment of the auditor, because all of these criteria are not really like a rule. They are more of like applying the judgment in relation to a particular situation and then assess whether those matters are really significant enough to be reported in the auditor's report or not. Okay, so now moving further onto those criteria, you can just also see on your screen, the standard says the auditor shall determine from the matters communicated with those charged with governance, those matters that require significant auditor's attention in performing the audit in making this determination. And the auditor shall take into account the following: areas of higher assessed risk of material misstatement or significant risks identified in accordance with auditing standard. Second, significant auditor judgments relating to areas in the financial statements that involve significant management judgment, including accounting estimates that have been identified as having high estimation uncertainty. Third, the effect on the audit of significant events or transactions that occurred during the period. Okay, yeah. So let's look at all of these things one by one. So one is, we are saying higher risk, which is assessed, or we can say the items which were considered to be of significant risk in relation to the audit of the financial statements. Second is which required significant judgments third, which required significant efforts. These criteria will determine the CAM. As we also discussed, that it's not necessary that if a matter is reported as a CAM, then there must be some modification in relation to that matter. It's not necessary. And anyways, if a matter gets modified, or if a matter gets reported in the form of a modification, then it has to be something which is in the nature of a kind of highlight. So that's why it will not really get into that situation. So we can look at some examples now in relation to all of these points to get into the details around the CAM. In relation to the financial statements of a company, revenue recognition is one area which is considered to be of significant importance, and of course this is considered to be a significant risk area. During the course of the audit of the financial statements, this is considered to be one area which will have significant risk always. That's why this will be one area which can be considered to be a matter which may get reported under CAM. Now, just because it's a significant risk, then should this get reported as a CAM or not is again judgmental. But of course, on the basis of the criteria which is prescribed, will this item qualify for being a CAM or not? Yes. So we can say yes, of course, this will be qualifying for being a CAM. Okay. Then Sumit has a query. Sumit is asking, if the matter is so significant, then why not to give a qualified opinion? CAM is in between this qualification? No. CAM is not at all in between this qualification. CAM is something which is completely different. What we can do is, we can just currently understand only the requirements of CAM. Let's suppose if you have a confusion between CAM and qualification, let's ignore qualification for the time being. Let's forget that concept, whatever you know for the time being. Let's concentrate only on CAM. Try to understand its criteria. Okay, and very soon we are going to discuss around some of the requirements related to qualification also. Once we are done, then we can compare both of them. Okay, and currently, just one point you can remember in relation to understanding the differences between these two. That in relation to CAM, we do not say that there is a material misstatement in the financial statements. Okay, CAM doesn't have this criteria, and this criteria is necessary for a qualification. Okay, for the time being, this will help you to differentiate between these two, if at all you want to do this. Yeah. Okay, moving further. So we discussed one item, that is revenue recognition. Second item, significant judgment. Let's suppose fair valuation of assets and liabilities was done in respect of business combination. So during the year, company had certain acquisitions, okay, which qualified the criteria for a business combination as per Ind AS 103, wherein fair valuation was done. Okay, so the purchase price allocation was done, and that was done on the basis of the fair values. And this area, because this was fair valued, this had various estimates involved, and that's why a lot of judgment was required there on the part of the auditor. And that's why this area can also be the matter of something which gets reported as CAM as per the criteria which is given over here. So we are saying that this will qualify. This will eventually, whether this gets reported or not, is again on the judgment of the auditor. Okay. Ambika is saying some matter which is included in qualification. So for qualification, the matters which will get included over there, we'll discuss when we'll discuss the qualifications. For the time being, forget the qualification. Okay. Third, significant efforts are involved. Let's suppose during the course of the audit, one area which required significant time on the part of the auditor, say that was inventory, or say that was inventory valuation. In respect of inventory valuation, there was no significant judgment. It was all arithmetical checking. It was all calculation based working. So no judgments were required as such. Everything was as per the policies and procedures. So there was no judgment. Forget the significant judgment. This may be one area which had significant risk as per the assessment of the auditor, or may not be the one which may be having significant risk, but for sure that the efforts of the auditor were involved significantly on this area. Significant efforts were involved on this area. Okay. Now, because the efforts were significantly involved in respect of this area, that's why in this situation, we can say that this item will also qualify for being a CAM. There again, whether it gets reported or not, this is again a matter of judgment. But as per the criteria, if we go, this may get reported as a CAM. Okay. Now, with this, what is it that we understand? That the criteria which are given may make a particular area as eligible. On the basis of criteria, various matters may become eligible for the purposes of being a CAM. But eventually, whether those are reported or not is the next stage. So there may be 10 matters which are eligible for being a CAM. But those matters again are not necessarily reported. Maybe only 4 matters are reported. Now this is something which the auditor has to decide. Okay. Secondly, it's not a necessity to report a matter in the auditor's report as a CAM. Let's suppose for a company, say no matter has been considered to be a CAM, because as per the judgment of the auditor, there was no matter at all which would have qualified or which should get reported as a CAM. So there again, it's not a necessity that because this is the requirement, so even if the company doesn't have any matter, still that should get reported as CAM. It's not a necessity. Okay. Third, in respect of CAM, once again, we cannot say that a number is specified. So if we say it doesn't have to be 0 or it can be 0 also, once again, if we look at the number, there is no number which is prescribed that 4 matters should be reported, 5 matters should be reported. It's all completely judgment. Okay, clear on this? One thing is for sure, that if a matter is qualified in the auditor's report, qualified means modification is given in respect of that matter in the auditor's report, then it would automatically become a CAM. Why? Because that matter will be of significance to the auditor, and that matter will definitely be involving a significant risk, and that matter would have also required significant efforts on the part of the audit team, at least the senior members of the audit team, in relation to assessment, in relation to forming the audit procedures, in relation to discussions with the management, etc. So that's why that matter will automatically become a CAM, and that matter will also be reported in the auditor's report anyways. Okay, clear? Now a question arises in respect of all of these matters, how do we really report? Yeah, for the reporting of a matter as a CAM, we discussed. So I'm just quickly revising that aspect, that whenever a matter will be reported, first of all, a description of the matter should be given. So we will describe about this revenue recognition for a company. Means how is the revenue recognized? So even though it's appearing in the accounting policy, the basis of revenue recognition, some more details around revenue recognition will have to be included in the auditor's report. Number two, what were the audit procedures performed in relation to revenue recognition? What were the audit procedures performed in relation to fair valuation? Those audit procedures will also be required to be given in the auditor's report. Okay. Then on the basis of these audit procedures which are performed, what's the final conclusion? Means, was it all fairly stated in the financial statements, or was there some problem because of this matter in the financial statements? So all of these aspects are required to be included in the auditor's report. Okay. I'll not get into too much details around this CAM in terms of how this is reported in the auditor's report, because we plan to cover auditor's report after this. So that means after this SA 701, we plan to move on to 700. Therein we'll understand all the requirements of the auditor's report, and therein we will also understand as to how this actually gets reported in the form of the auditor's report. Okay, yeah. So moving further, if I take you to the presentation, and this will hopefully answer some of your queries. If you can read this para number 12. The auditor shall not communicate a matter in CAM when the auditor would be required to modify the opinion in accordance with SA 705 as a result of the matter. See, the point here is that CAM is not a substitute for a modification. Let's suppose, because of this fair valuation which took place, or in respect of this fair valuation which took place, there was some material misstatement. Means there were certain misstatements which were material, and because of which auditor is not happy with the financial statements in terms of their truth and fairness. So that's why, what would he want to do? He would want to qualify the report. But instead of qualifying the report, can the auditor say that I'll not qualify the audit report, I'll not modify the report, I'll put this matter as a CAM. And because this matter is reported in the auditor's report in the form of a CAM, that means it's appearing in the auditor's report somewhere, whether it's CAM section or something otherwise. Can that be done? And can that become the basis for not giving a modification in respect of this? The answer is no. As we discussed, that reporting of a matter as a CAM doesn't relieve the responsibility of the auditor in respect of his reporting requirements for modifications. So modification will continue to be there. Secondly, it cannot also become, a kind of will wherein the auditor can say that because this matter is already reported, that's why the modification should not come now. Clear? It's not a substitute for modification. Secondly, the auditor shall describe each CAM in the auditor's report unless law or regulation precludes public disclosure about the matter, if there is any such matter. Or in extremely rare circumstances, auditor determines the matter should not be communicated in the report because the adverse consequences of doing so would reasonably be expected to outweigh the public interest benefits of such communication. This shall not apply if the entity has publicly disclosed information about the matter. Okay, clear on this? Now moving further, some of the other points which you need to know about CAM, and then we'll move on to the next auditing standard. Interaction between CAM and the other requirements of the auditor's report. Now this is important. A matter which is giving rise to a modified opinion or a material uncertainty related to events or conditions in respect of going concern are by their very nature key audit matters. However, in such circumstances, these matters shall not be described in CAM, and the requirements of this auditing standard do not apply. Rather, the auditor shall report on these matters in accordance with other auditing standards which require the auditor to either modify or either report them as material uncertainties, and include a reference to the basis for qualified opinion or the adverse opinion or the material uncertainty related to going concern section in the CAM section. So let's suppose if there is a modification. Now that modification has been reported in the auditor's report, then the basis for modified opinion is also given. When it comes to CAM, so in the CAM you will not be reporting, you will just be giving the reference of those matters. Okay, clear? Yeah. So these are some of the requirements in respect of CAM which we need to understand in line with any other matter which is otherwise required to be reported in the auditor's report. So to put it simply, if we have to understand this requirement, what we can say is first of all, okay, so we can say that first of all, an auditor should look at other reporting requirements. And then he should look at CAM. Say for example, a matter, other reporting requirement for example is modification. Say a matter gets reported in the auditor's report or should get reported in the auditor's report as modification. So what's the best way? First of all, to check whether it will be a modification or not. If it's a modification, then it will come as a modification and not really as a CAM. It may or may not become a CAM, that's a separate thing. Secondly, let's suppose emphasis of matter is required to be given. Emphasis of matter is required to be given. This is matter number 2. Now, because this is emphasis of matter which is required to be given, that's why in this scenario, what do we say? This is appearing as emphasis of matter, and because of which this anyways is a matter of significance, or we can say it's a key audit matter. But first of all, we should evaluate whether it will be a modification or this any other matter, rather than just simply looking at it in scam. Because when you look at it on the basis of these criteria, then they will automatically be qualifying the criteria of a CAM. Yeah. So the best way is to just move in this way or on this hierarchy in relation to assessment of a matter as a CAM. Okay. We will get more clarity around all of these things, because you may have some confusion around emphasis of matter, around modification like you asked me, and the CAM. So once we are done with all the requirements of the auditor's report, then we'll come back to understanding of differences between all of them. CAM, emphasis of matter, modification, whether it's in the nature of qualification or an adverse opinion. Okay, clear on this? Yeah. So now we can move on to the next auditing standard, and basically that's all about auditor's report. So we'll now start with SA 700. If you have any questions in relation to this, please let me know. SA 700 is about the auditor's report. Okay, yeah. So we have actually now come to the requirements of audit report. Audit report, we can say, are of 3 types. One is the main audit report, and then we have certain annexures to the auditor's report. I'll just first of all give you some perspective around it. One is the main report. Now, what is this main report or so-called main report? I'll let you know. Okay. We'll come to this. Then there are few reports which go along with this, and which are specified in the main report itself. Means a reference of those reports are given in the main report. One is the report on IFC. IFC means internal financial controls, and other one is CARO, Companies Auditors Report Order. Okay. Now this report basically talks about, or this is all about expressing an opinion. And in terms of opinion, it requires the auditor to express an opinion about the truth and fairness, means true and fair view, whether auditor would like to give on the basis of his audit true and fair view in respect of the financial statements. And this can be done only when the financial statements are not materially misstated. So when the financial statements are not materially misstated. Important thing is material, because if the financial statements have misstatements but those are not material, then it's okay. Second report is not something which is applicable to all. So this report is applicable to all the companies. So whether this is a small size company, large size company, listed, unlisted, irrespective of whatever is the size, this report will go for each and every company. However, if we look at these two reports, there are certain criteria which are prescribed, on which we'll go later on. We'll not get into those criteria now. On the basis of those prescribed criteria, these reports are required to be given. And in respect of these reports, there are certain specific reporting requirements. It's not related to expressing an opinion on truth and fairness of the financial statements. IFC is all about internal financial controls. So this report is all about reporting specifically on internal financial controls, whether there are any weaknesses in that or not. And CARO, as we all know, is all about reporting on certain specific matters. Okay, yeah. Now moving on to the requirements of the auditor's report. As regards the auditor's report, the format is prescribed. So even though the auditor applies his judgment in relation to various reporting requirements, the format of the auditor's report is prescribed, and the order in which various items are required to be included in the auditor's report are also prescribed. It's not something which is a free will to the auditor. Okay, auditor needs to check in respect of all of those prescribed requirements what all items will be included there. But this format cannot be changed by the auditor. Format has to go in line with the requirements. Okay. So now we will start with this report. We'll understand the order, we'll understand the various requirements which are prescribed for the reporting, and along with this, We will also touch upon these two requirements. We will not get into too much details around both of them. We'll just touch upon them. We'll just try to see as to what all reporting requirements are covered over there. Okay. Yeah. Then what we can now do is we can understand some of the requirements related to auditor's report. I'll take you to the presentation once again. So now we are talking about the main report. There's no term main report as such. It's only for the purposes of our discussion that I'm calling this as main report. Now, audit report, as we all understand, is the only deliverable which goes from the auditor to the management or to the company in respect of audit services which are performed by the auditor. This is the only deliverable which goes. And the audit report has to be in writing. So it cannot be verbal. Auditor cannot say that auditor will be giving his opinion verbally to the management. That doesn't work. Audit report has to be in writing, and this has to be signed by the auditor. Now, writing doesn't mean that we need to just write it by hand. Writing means this has to be a document in writing, which can be printed or which can be either way covered over there. Now, now the auditor's report is all about expressing an opinion. So the key thing which the auditor requires to cover over there happens to be his opinion. So in respect of his opinion, let's try to understand what is this opinion that this audit report would cover. The opinion section of the auditor's report shall talk about the truth and fairness, or the view of the auditor in respect of truth and fairness. Herein, the auditor will also specify that the entity which has been audited, okay, so that entity will be specified over there. That the financial statements of such entity have been audited. Title of each statement comprising the financial statements. And what can be the elements of the financial statements or various statements in the financial statements? Balance sheet, statement of profit and loss, cash flow statement, notes to accounts. All of these are what? Parts of the financial statement. So all of them will also be specified in this section. Then they will also specify the date of and period covered by each financial statement. Means the period. For example, the financial statements are getting audited for the year ended 31st March 2020. So this will also be specified so that the users can understand which entity has been audited and what were included in their financial statements and for which period this audit report belongs to. So all of these things will be required to be covered in the financial statements. Sorry, in the auditor's report on the financial statements. Then there are various other requirements in relation to the auditor's report. Let's look at some of those requirements now. Broad. Number one, we are saying opinion should be there. Okay, so I'm just talking about some of the important requirements. Opinion should be there, including the basis for the opinion. Another thing which the auditor's report should specify is about the responsibilities. In terms of responsibilities, the report should specify the responsibilities of the management, responsibilities of the auditor, both of them. Correct? Both these requirements should be specified so that when somebody is looking at the financial statements and the auditor's report, he will understand what were the responsibilities of whom. There should not really be any confusion. As regards the management and the auditor, they know about their responsibilities. They have also documented this in the form of an engagement letter, which was executed between both of them. But still, this is not something which has gone out to the users of the financial statement. So that's why it's very important to include this once again in the auditor's report, and even for the purposes of the management, even for the purposes of the audit committee or the board of directors, it's important to once again clarify in the auditor report itself that these were not really the responsibilities of mine being an auditor. Okay. And then the auditor's report will include certain other reporting requirements, or we can say other requirements. And there's basically a flow in which all of these requirements will come. So what we can now do is, instead of just discussing all of these requirements theoretically, what we can do is we can just look at one actual audit report for a company, and we can pick up any listed company, and we can just try to check as to what all went into the reporting of that company in terms of their auditor's report, and what was really the flow. And through that auditor's report of that company, will also try to understand what all were the reporting requirements and how those reporting requirements were included in that report. Okay, yeah. So now I'll take you to one auditor's report. All right, so what you will now see on the screen is this auditor's report, and I'm not really sure about its size. Let me just try to increase this a bit. So I'm just hoping that this is now visible to all of you. Okay. And if you want, and if you just want to refer this, you can also download this. So it's available on public domain. You can just do Google and download this audit report. So you can see the name of the company. The period is year ended 31st March 2020, because that's the latest period for which financial statements will be available, and therefore the report will be for 31st March 2020. And you can just download any audit report. Okay, and we can just look at that report, and through that report we'll look at the various requirements. So what's the first requirement? First requirement starts with the title. And what is the title over here? So this is something which you see as a title. Independent Auditor's Report. So this is the title which is given. Title is what? Independent Auditor's Report. Any audit report will start with the title. Always. Okay. Moving on to the second requirement. Every auditor's report will have addressee, means to whom audit report has been addressed. Now, if we look at the audit report of the statutory auditor, where is this required to be, or to whom is this required to be addressed to? The auditor's report is required to be addressed to the shareholders, the members of the company. So that's why, what do you see in this case? To the members of the company. So this is the second requirement, and this is also the order in which you have to move. So we cannot really disturb this order. We cannot really say that this is something which will come later, or this is something which can be put up first. Okay. Yeah. So the second thing is about the addressee to whom this auditor's report is required to be issued. Okay. Third is about this. Is this really a kind of subject that is about report on the audit of standalone financial statements? So this report is on the standalone financial statements. This is not really on the consolidated financial statements. So that's why it's been specified as standalone financial statements. Then we begin with the opinion. So what's the next section after this? The next section after this happens to be the opinion. Earlier, it did not start with opinion. Now, for last couple of years, this format got changed. And now any report starts with the first thing, any report starts with this thing, opinion, because that's the most important part of the auditor's report. As we discussed that it's all that comes down to the opinion in the auditor's report. So that's why this is the first thing which happens to be the one which is required to be reported in the auditor's report. Opinion. Now, what do we mean by opinion? We understand. Now, let's see how is this really required to be reported. We also understood some of the requirements of the opinion, and now we'll see as to how that has been presented, how that has been written in the auditor's report. Okay. We have audited, so I'm just reading this para. We have audited the standalone financial statements of the company. So what are they specifying? Name of the entity. And auditor is also specifying that auditor has audited the financial statements of this company. Then auditor is specifying what do these financial statements include. So therein the auditor is saying which comprise the standalone balance sheet as at 31st March 2020. So he's also specifying the period now. So it's not only the elements of the financial statements. He's also specifying the period. So one may really think that when the financial statements have been specified, will it not automatically cover all of these elements? Yes, but still the auditor is required to specify that in respect of the financial statements, what is it that the users can get to see? Because first of all, the auditor's report will come and then the financial statements will follow. Okay. Which comprise the standalone balance sheet as at 31st March 2020 and the standalone statement of profit and loss, including other comprehensive income, standalone statement of changes in equity, means the statement of changes in equity, statement of cash flows for the year then ended. Now for all of them, for the P&L, for the statement of changes in equity, for the cash flow, once again the period has been specified. What's the period? For the period then ended. Then ended means which ended as at which ended means 31st March 2020. That ended. And the notes to the financial statements, including a summary of significant accounting policies and explanatory information and the notes. And this includes two joint operations consolidated on a proportionate basis. Okay, so that's the information specific to the company. We are not getting into it. Clear? So herein few things which have been reported and which we discussed. Yeah, in the presentation we discussed. Entity's name has been given. Financial statements have been specified. Elements of financial statements have been given. Then the period of all of these elements have been given. Correct? Each and everything in detail has been brought out in the auditor's report. And this is all mandatory. So why is this auditor giving all of these things? Because these are all coming from the requirements of the auditing standard. So auditor will have to specify all of these things. Next para is the most important para, I would say, of any auditor's report. So let's read this next para. In our opinion, and to the best of our information and the explanations given to us, and based on the consideration of report of other auditor on separate financial statements of joint operation as was audited by other auditor. So this line you can just ignore. The aforesaid financial statements, aforesaid means financial statements for the year ended 31st March 2020. Give the information required by the Companies Act in the manner so required, and now comes the most important line. Give a true and fair view in conformity with accounting principles generally accepted in India and of the state of affairs of the company and the loss and other comprehensive income, changes in equity and its cash flows for the year ended on that date. So let's now try to understand. Now in this para, what did the auditor report on? After specifying all of these things that these have been audited. So first of all, auditor is saying, I have audited these things. Now after he audited these things, what's the outcome? Outcome is, auditor is saying that financial statements give a true and fair view. So that means he is giving a clean opinion. True and fair view means clean opinion. His opinion is clean. There is no modification in this report. And in respect of this true and fair view, Once again, the auditor is bringing out each and every element. Here, he mentioned balance sheet, he mentioned P&L, he mentioned statement of changes in equity, he mentioned cash flows, then he mentioned notes, etc. Correct? All of these elements were specified by the auditor that this is something which he has audited. Now, once again, what is he doing? Now, once again, he is commenting on each of them in respect of his view. So he's saying, I'm just reading this once again for you. He's saying of the state and of the state of affairs of the company. So balance sheet gives the state of affairs of the company. Correct? Then he says loss and other comprehensive income. P&L gives loss and other comprehensive income, or if there is a profit, it will be profit. Then it says changes in equity. So this is all about changes in equity, which is coming from statement of changes in equity. Then it says cash flows for the year that ended. Correct? Yeah. So once again, if we look at the requirements of the audit report, what does it specify? It not only specifies the auditor to give true and fair view, but it also requires the auditor to bring out about the financial statements in detail in respect of the various elements which it will have, plus to comment on all of them one by one, something like this, what we have done, or what this auditor would have done. Okay, clear on this? Clear on the opinion section? So we can say this is one section of the auditor's report. Clear? Yeah. So we can also say that this is the most important part of the auditor's report. If you have any queries around any of these points that we have been discussing, just keep asking me about all of them. Huh? Next, so I'm just now moving in the order. Okay, so we started with title, etc., then the opinion. Now, after the opinion is given, audit report should include the basis for such opinion. Basis means if the opinion is clean, what's the basis for clean opinion? If the opinion is modified, what's the basis for modified opinion? If the opinion is not modified, but the report includes, say, emphasis of matter. So what's the basis for that? Even that will get covered over here. Now, because this report is clean, that's why it starts once again with basis for opinion. Okay, and then this will change. Let's try to understand how. If you look at this auditor's report, for every para, a subhead has been given. Yes or no? For every para or for every section, its subhead has been given. And what's the relevance of giving this? The relevance is to make it easily understandable for the users. And it's easy reference for the users. Because if anybody wants to get into this report, they will not be required to read each and every line, each and every para to understand as to what does this para conveys. The header, or we can say all of these subheads, they help the user to understand what all is covered there. So opinion means he will know that if he has to read anything about the opinion, this is the first section that he will need to read. If he wants to understand the basis for opinion, then he will look at it. So that's why all of these subheads go into the auditor's report. Clear? Now I was talking about this head or this subhead in relation to basis for opinion. Now this subhead will change depending on the opinion. For example, if the opinion is not clean, if the opinion is modified, then instead of basis for opinion or instead of writing it as basis for opinion, what would be written over here? Basis for modified opinion. Now, what can be the modified opinion? It can be in various ways. So, modified opinion could be having a qualification, or this could be about an adverse opinion. Yeah. Or there could be a disclaimer. So, what will be written over here? Either it will read as basis for qualified opinion, basis for adverse opinion, basis for disclaimer opinion. Okay, clear? Yeah. So this head you will have to remember may change. So let's understand in the given case when the opinion is clean, or when the report is clean and there's no modification in the opinion. So what do we write? Now the auditor will be giving a sort of explanation as to why he has given a clean report, why his opinion is clean. Okay. So let's read this paragraph. I think before this, I have one query from Sumit. Sumit is asking why to give opinion on cash flow statement? Because it's a part of the financial statements and this is also audited by the auditor. So something which is audited by the auditor is required to be included over here. Next, we conducted our audit in accordance with essays. What are essays? We just something which we have been discussing for quite a while now. Specified under section 143 subsection 10 of the act. Act means they must have specified this somewhere. If you look at the opinion para, they have defined the act. They have specified that wherever Companies Act 2013 will come, they will specify this as act. So this is Companies Act. So that means essays which are mandatory as per the requirements of the Companies Act, the audit has been conducted in accordance with them. Our responsibilities under those essays are further described in Auditor's Responsibilities section. So in this basis, auditor is saying that we had some responsibilities as per those essays. And in this report, auditor is saying in this report, when you will move further, you will also find in detail about our audit responsibilities. So auditor is not explaining his responsibilities over here. He is giving a reference of his responsibilities in this para. Okay. Second, we are independent of the company in accordance with Code of Ethics issued by ICAI, together with ethical requirements which were relevant for this audit under the Companies Act and any rules thereunder. And we have fulfilled our ethical requirements in accordance with Code of Ethics. So what's the next requirement in the basis for opinion? Auditor is saying that he has been following all the Code of Ethics. And the most important thing, that he is independent. Because if the auditor is not independent, then can he conduct the audit? Not at all. But it's a specific thing which is required to be included in the auditor's report. And you will be thinking, but sir, when we know that audit could not have been conducted if he was not independent, when we know that all of these compliances would have been taken care of by him, then what's really the need to include this? It's a specific thing. It's similar to what I told you earlier, that whenever anything is specifically required to be included, written somewhere, so its relevance increases. The same is the case over here. So auditor will have to specify about his independence in the basis for opinion. Then it reads, we believe that the audit evidence obtained by us, along with the consideration of our audit report of the other auditor, which is referred to in other matter para. Okay, so let's again ignore this line. So he's saying, we believe that the audit evidence obtained by us is sufficient and appropriate to provide a basis for our opinion on the standalone financial statements. Now the auditor is saying that why has he given a clean opinion? Because he is saying that the evidence which I have obtained was sufficient as well as appropriate. You remember sufficient and appropriate? So this is something which the auditor has specified. Now with this para, what is it that the auditor has done? Auditor has actually justified his opinion in relation to this. He has explained his basis for giving such opinion. So what has been the basis? One is he is saying I worked as per the requirements of essays. Second, he is saying I worked independently. I followed all the code of ethics. Third, he is saying that I obtained the audit evidence as per the essays, and the audit evidence which I obtained was sufficient as well as appropriate. That's why I'm giving clean opinion. Okay, yeah. So this basis for opinion has to come immediately after the opinion section. Okay, clear on this? Okay, then I see Ambika is saying, sir, the quarterly report will also follow this pattern. I think when you talk about the quarterly pattern or the quarterly report, you must be talking about the report which is required to be given for the listed companies in respect of their financial results. Now, in that case, you will have to remember one thing, that when it comes to the quarterly report, is that for audit or the scope is not really the audit? If the audit is conducted, whether it is for full year or for 1 quarter, and that audit requires application of all the auditing standards, then of course this is the format of the auditor's report. But let's suppose for quarterly thing, audit has not been conducted, it's a review, it's a limited review, okay, for which there is a separate auditing standard, then this format will not come. Then there is a different format. This format which you see is for audit. Okay, clear? Moving further on to this, the next section which you see in the auditor's report is about reporting on going concern. Wherever it is applicable, auditor will report anything in relation to the material uncertainty, etc., around the going concern. In the report which you see right now, there's nothing which is specified in relation to the material uncertainty. Why? Because this company will not have that situation. This company may not have anything in relation to the material uncertainty, etc. Okay, so that's why this section is not coming over there. Because this section is not mandatorily required to be given. See, there are certain sections of the auditor's report which, even if may have a nil balance, which even if there is nothing during the year, are still required to be commented upon by the auditor. Wherein the auditor would be required to comment that this was not applicable. This was not applicable. Okay, something like this will come. But this section of the going concern is something which is required to be reported only when it is applicable. Now, in the given case, it was not applicable, hence this has not been given. But you need to understand that this is the next thing which will come. Now we move on to the next section. And something which we have discussed, and now we will see that practically, that is about CAM. CAM we discussed. Next in line will be the reporting under CAM. Key Audit Matters. We all know about CAM. Correct? We all know about CAM. So let's see how is this CAM required to be reported. Key audit matters are those matters that in our professional judgment, so I'm just reading this para, were of most significance in our audit of the standalone financial statements of the current period. This is another very important point. So auditor is saying, first of all, briefly about the CAM in general. So he's saying these were most significant during the course of our audit in the current year, for the current year. These matters were addressed in the context of our audit of standalone financial statements as a whole, and also informing our opinion thereon. Secondly, the most important point of this section, and we do not provide a separate opinion on these matters. So auditor is clarifying here that all of these matters which I am reporting now, they have gone behind the opinion which I have shared with you. But if I am reporting all of these matters, that doesn't mean that I am giving opinion on these matters. Why? Because the opinion is given on the financial statements as a whole and not separately on all of these matters. Clear? Yeah. So this is something which is again a requirement of the auditor's report. Now, all of these matters will start. And depending on whatever is the matter, all of these matters will be reported. So what is the first thing that will come? Description of key audit matter. So under this, whatever was the matter that would be described. You can see on the left hand side, first matter has been explained. And when the explanation is given, a reference is given to the notes to accounts. And further explanation is also given. If you want to read this, you can read this, but we are not required to get into this specific matter. So don't pick up your queries on the basis of the specific matter. We'll keep it very, very generic. Whatever is this matter, we don't know. And anyways, I have not audited this company, so I will not be able to comment about this matter at all. Next, on the right hand side. Now, this is again the layout. We are giving the description. On the right hand side, we are giving the procedures around this matter. So auditor is saying the impact of corona on this company was the matter. Now for this matter, what all procedures have been performed by the auditor. So let's read some of the procedures which have been performed by the auditor to deal with this matter. So auditor is saying, in view of the significance of the matter, we applied following audit procedures in this area, among others, to obtain sufficient appropriate audit evidence. So let's see what were the procedures. Obtained an understanding of company's internal controls over its forecasting process. And you may be thinking, sir, obtaining an understanding became a procedure. Of course, yes. As I told you, and this is something which we discussed quite a lot. discussions, inquiries. These are all what? Whatever auditor is doing, that is nothing but an audit procedure. Okay. Compare the key assumptions adopted by the company in preparing the forecasted cash flows with our expectations based on actual cash flows of 1920 and our understanding of changes to the company's business. Assess the sensitivities and performed testing on the cash flows. Examined the funding arrangements of the company. Assessed the adequacy of disclosures related to application of going concern. Okay, clear? And then he found everything to be okay over here. Then he moved on to the next matter. Then he moved on to the next matter. Just 1 minute, I'll also change the slide. Now, similar to this, just 1 minute. Now, moving further on the next page, another matter has been reported by the auditor as Cam. So I'm not getting into the details because we have understood as to how that matter is required to be obtained. Next, point number 3, if you'll see, this is again another Cam which he has reported. There again, he has first of all described the matter. Then he has written the procedures on the right hand side. Okay, he has written the procedures which he has performed. So if he has performed test of controls, he has specified it. If he has performed test of details is what? Substantive testing. So both of them he has given specifically and under 2 brackets. Clear? Yeah. Okay. So his reporting under Cam after this is complete. So he's done with his reporting under Cam. Okay. So now I'm just hoping that you would have got better clarity around Cam. Yeah. Around Cam, audit procedures, you must have seen. This really doesn't require the auditor to comment on the key procedures. Even a basic procedure, or even if there was a very simple procedure which the auditor would have performed in relation to the audit of that particular matter that has come. Yes or no? That was reported by the auditor. So that's why each and every point over there will come. Okay, clear? Next section will be about other information. So let's read through what is this next section. What is this other information? The company's management and the board of directors are responsible for other information. This other information comprises information included in the annual return of this company, but does not include financial statements and our auditor's report there. So let's try to understand what do we mean by this. See, the document which was viewed by all of you is called as annual report of the company. And I'm sure all of you would be knowing about the annual report of the company. Correct? Yeah. So this PDF which was open was nothing but the annual report of the company. Now this annual report of the company comprises of various items. It comprises of information about the company. I'm saying general information about the company, its address, its shareholders, various other information, its directors, etc. It has a directors report. It has directors responsibility statement. It has got MD&A, management discussion and analysis. MD&A means management discussion and analysis. Other financial information. Okay. Then of course, the financial statements along with the auditor's report, they are also included in the annual report. So auditor's report will come here. Then the financial statements will come here. Financial statements means complete set of financial statements. So if I look at the annual report, I can say that these are some of the items which get included in the annual report. I'm not saying all, some of the items which get included in the annual report. These are some of those items. Now, for the preparation of this annual report, who is responsible? Management. Board of Directors. So they are responsible for this document. Auditors are not responsible for preparation of this document. But auditors are required to ensure that if there is any information, let's suppose, which is going under this MD&A, let's suppose revenue is included in this analysis. Revenue of the company for the current year is discussed over here, and the amount of revenue has also been discussed. Let's suppose revenue was 510 crore, which has been specified in this document. Now, the shareholder or the user who will access this annual report, he will look at this annual report as one document, correct? And anyways, it's the document for the company for the current year. Let's suppose the current year is 2019-20. So when he will read this MD&A, he will understand that the revenue of the company is what? 510 crore for this year. Say, he also looks at the financial statements of the company then, and he finds that the revenue of the company is 515 crore. Okay, what does he find? He finds that revenue of the company is not really 510 crore, it's 515 crore. So will this lead to some confusion in the mind of this user? Of course, yes. Do we find this inconsistent? Of course, yes. And who is responsible for this? There's no doubt management and board of directors are responsible for this. They should have ensured that both these things are consistent. Why? Because revenue for the company has to be revenue. It cannot be other thing. Otherwise, it should be specified that it's not really revenue. Now, what is it that auditor is commenting on this particular part in his auditor's report? So let's get back to that annual report. this audit report once again and read. Auditor is saying that for this document, which contains various information other than my report and the financial statements, who is responsible for this? Management is responsible. Then he has also clarified that the other information comprises the information which is included in annual report, except but does not include financial statements, auditor's report. Why? Because auditor's report is his report only, and on the financial statements he is also giving an opinion. Then he is saying our opinion on the financial statements does not cover other information. So he's saying I have given my opinion only on the financial statements. I have not given my opinion on any of these information. So he has simply and categorically excluded all of these out of his purview. Okay. Next, he says, in connection with our audit of financial statements, our responsibility was to read other information. So this other information, in terms of its reading, was my responsibility, but its audit was not my responsibility. And in doing so, consider whether the other information is materially inconsistent with standalone financial statements, or our knowledge obtained in the audit or otherwise appears to be materially misstated. If based on the work we have performed, we conclude that there is a material misstatement of this other information, we are required to report that fact. We have nothing to report currently in this regard. So auditor is saying that audit of financial statements was my responsibility, which I have done, but these informations were not required to be audited by me. But I was required to read this other information and also ensure that there was no inconsistency like this. And if there was any inconsistency, then I would have reported such inconsistency over here in this section. But because I am not reporting anything over here, that means that all of these information which you will read, you will also not find any material inconsistency. Now, what is material? Again, this has to be based on the judgment of the auditor, because there can be some immaterial inconsistencies, but this should not really be the material. Okay, clear on this, all of you? Yeah. Moving further on to the management responsibility. Now comes the next point, and that is about responsibilities in relation to the financial statements. So auditor is saying, what is the responsibility of management, board of directors? Now this section is important. This section is important because of the fact that it clarifies what all things were required to be done by the management and what all things were required to be done by the auditor. Okay. In this section, if we have to look at it broadly, what is it that the auditor will say? That responsibility for preparation of the financial statements was with whom? It was with the management. Responsibility in relation to internal controls. Internal controls in relation to the financial reporting, whether those were operating effectively or not, was once again the responsibility of whom? Management, or those charged with governance. Okay. So again, whenever I'm saying management, it's something which includes governance. Okay. Nowhere it will specify that giving a true and fair view or expressing an opinion on those financial statements is the responsibility of the management. So it clarifies in detail in this section about various responsibilities of the management, and will not get into too much detail around it, but we'll just quickly read through this para. The company's management and the board of directors are responsible for the matters stated in section 134 subsection 5 of the Companies Act with respect to preparation of financial statements that give a true and fair view of state affairs and all of these things, including the Ind AS specified under section 133 of the Act. So herein, auditor is specifying that these financial statements which were required to be prepared as per Ind AS, this was again the responsibility of the management. Then the auditor says the respective management and the board of directors are responsible for maintenance of adequate accounting records in accordance with provisions of the Companies Act for safeguarding of the assets of the company, prevention and detection of frauds and other irregularities, selection and application of appropriate accounting policies, making judgments and estimates that are reasonable and prudent, design, implementation, maintenance of for ensuring design, implementation and maintenance of adequate internal financial controls that were operating effectively for ensuring accuracy and completeness of accounting records. Yeah, so you can see that all of these details are given by the auditor in relation to the responsibilities of the management. Okay, clear? Then the auditor says, in preparing the standalone financial statements, the respective management, board of directors are responsible for assessing the ability of each company to continue as a going concern, disclosing as applicable matters related to going concern, and using the going concern basis of accounting unless the board either intends to liquidate or to cease operations. Okay. Respective board of directors are responsible for overseeing the financial reporting process of each company. Now he is using the terms respective because this also includes a couple of joint operations. Otherwise, it will be all about the board of directors of the company. Our perspective is to understand that in what detail, in what manner responsibilities of the management have been brought out by the auditor. Why? This is important because of the fact that users will get to know that these financial statements which are prepared are not prepared by the auditor. The controls, etc., in relation to these financial statements were all responsibility of the management and not the auditor at all. Okay, clear? Now comes another important section of the auditor's report, and I'm just calling this to be important because this is from the perspective of the auditor. For the auditor, it is important because now he is sharing his responsibilities in relation to audit. Earlier in the auditor's report, he has commented, he has actually expressed his view, but now he is talking about in detail all the responsibilities which he had. So he is not talking about the audit procedures which he has performed. He is talking about the requirement of audit procedures which he would have performed. Okay, clear? And this comes after the management's responsibilities. So let's see what is it that is required on the part of the auditor. auditor says our objectives are to obtain reasonable assurance. Now, what do we mean by reasonable assurance? Means we are not giving absolute assurance. We are only giving true and fair view. Reasonable assurance means we have not tested each and everything. We have done a test check by taking certain samples. It's not about 100% testing that we have done. Okay. Reasonable assurance means commenting on the financial statements by keeping materiality as a perspective. Okay. So the auditor is saying our objectives are to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error. Means for both the reasons, if there was any material misstatement, that was my responsibility. And to issue an auditor's report that includes our opinion. So this was also my responsibility. And then he is explaining about the meaning of reasonable assurance. Let's understand. He's saying, what is reasonable assurance? It's a high level of assurance, but it's not a guarantee. So it is saying, I am not giving any guarantee that the audit which I have conducted as per the requirements of auditing standard will always detect a material misstatement. When it exists. Okay. He is saying it's not necessary that each and every error will be detected by me and every time it will be detected. Then he is clarifying, misstatements can arise from fraud or error and are considered material if they could reasonably be expected to influence the economic decisions of the users. Then he is specifying the meaning of materiality. That whenever he is talking about material, what does it mean? Then he is continuing on his responsibilities. He is saying, as part of an audit in accordance with SA, we exercise professional judgment and maintain professional skepticism throughout the audit. Then he is saying we also identify and assess risk of material misstatement. So he's just talking about the assessment in terms of the risks for financial statements that he would have done. Then the next para, he's saying we also obtain an understanding of internal control. Why? So that we can design our audit procedures accordingly. Then he's saying we also evaluate the appropriateness of accounting policies, which are prepared by whom, which are selected by whom? Management, but we evaluate. Then we also conclude on the appropriateness of the management and the board of directors use of going concern basis of accounting in the preparation of standalone financial statements, and based on the audit evidence obtained, whether a material uncertainty exists related to events or conditions that may cast significant doubt on company's ability to continue as going concern. If we conclude that a material uncertainty exists, we are required to draw attention in our auditor's report to the related disclosures in the standalone financial statements. Or if such disclosures are inadequate, to modify our opinion. You remember when we were discussing about going concern, we discussed about material uncertainty. So this is again explained by the auditor. So it's the guidance which he has shared. So he's saying if the material uncertainty existed and this was properly disclosed, then I would have given an attention in my report itself by giving reference to that disclosure. But if the required disclosure would not have been given by the management, then I would have qualified my report. Our conclusions are based on audits obtained up to the date of the auditor's report. So this cutoff he's doing. He's saying till the date I signed the auditor's report, I have obtained all the evidences. After that, if anything arises, I am not responsible. However, future events or conditions may cause the company to see as going concern, for which I cannot be held responsible. Then he's saying, these are all responsibilities. So he's saying, we also evaluate the overall presentation, structure, content of financial statements, including the disclosures. Okay. Then he's saying, we also obtain sufficient appropriate audit evidence regarding the financial information of the company to express an opinion on the financial statements, of which we are the independent auditors. We are the direction, supervision, performance of audit of financial information. Okay, we remain solely responsible for our audit opinion. Now he's saying, if you read the last para and the second last line, he's saying we remain solely responsible, means we are the only one who are responsible for audit opinion and nobody else is responsible for the audit opinion. Our responsibilities in this regard are further described in the section titled Other Matter in this audit report. So in this particular audit report, there are some matters which he wants to highlight. So that's why he has given other matters para. Otherwise, this will not generally come. Okay, clear? Clear? Moving further, now we are still continuing on the auditor's responsibilities. He is then saying, we believe that the audit evidence obtained by us, along with the consideration of audit report of other auditor, which is specified below, is sufficient and appropriate to provide a basis for our audit opinion on the standalone financial statements. Then he is also clarifying, we communicate with those charged with governance. So all of those requirements of the communications to those charged with governance in relation to various matters, in relation to controls, the significant deficiencies in the control, the weaknesses or the material weaknesses in relation to the control, he's just commenting on that part. Then he's saying, we also provide those charged with governance with a statement that we have complied with relevant ethical requirements regarding the independence and to communicate with them all relationships and other matters that may reasonably be thought to bear on our independence and where applicable the related safeguards. So he's saying, as around the independence, the ethical requirements which were required to be followed by us, we have done that completely. And we have also communicated about all of them to those charged with governance. Then he's saying, from the matters communicated with those charged with governance, we determine those matters that were of most significance in the audit of the financial statements of the current period and are therefore CAM. We describe these matters in our auditor's report unless law or regulation precludes public disclosure about the matter or when in extremely rare circumstances. Can you just read all of these points? You will be thinking, sir, these are all, but nothing. These are all which are given as a guidance in the auditing standard. So, is the auditor required to just put the guidance of the auditing standard in his auditor's report? Of course, yes, because he is bringing to the knowledge of everybody who is looking at his auditor's report what was his responsibility. All the responsibilities which the auditor had, he is bringing out that in the auditor's report. And all of these responsibilities are arising from whom? From the requirements of SA or from any of the requirements of the Act. Yeah, clear? Clear? All of these things have been brought out by the auditors in the auditor's report. Now, before we move further, we can take a break because we are not yet done with this entire part of the auditor's report. After the break, we'll continue with our discussion on the auditor's report. In the meantime, if you have any query, you can just let me know. And I have this query from Preeti. We'll discuss that before we go for the break. Preeti is asking, sir, if the audit gives reason, what is low level of assurance? Sometimes asked by the management in auditor scope. In this case, auditor may leave the audit engagement. See, assurances you can say can be of three types. One is absolute assurance, which is not given by anybody. Okay, which means giving a guarantee or sort of giving a guarantee. Okay, so let's forget that. Second is reasonable assurance, which means an audit. Or you can say auditing assurance. Third is wherein the auditor is not giving reasonable assurance, which could be in the form of negative assurance and which arises in the case of a limited review. At times, the management may not really require the auditor to do the audit. Instead, the auditor is required to do a review. That becomes a diluted form of this reasonable assurance, and that is called as low level of assurance or negative assurance. Therein, the auditor will not give the opinion, auditor will give a conclusion. Okay. In this case, as regards your next question, if this is a statutory audit, which is mandated by the law, for example, in India, this is mandated by the law, management cannot really cut down the requirements of audit. Because if the audit is required as per the law, then the audit will have to be performed and all the procedures in respect of audit will have to be performed by the audit. If that is not done, then it will lead to reporting implications. But if there is any specific audit or special audit which has been conducted as per the requirements of the management, and therein the management wants to cut down on the scope, then it's absolutely okay. There is no problem. Okay, clear? And I see a lot of your queries coming around the videos, etc. So all of these things are getting sorted. So please wait for, I think, some more time, and you will very soon get all of these recordings. Don't worry about it. So we can now take a break, and we'll meet after the break of 10 minutes. एक मिनट रुको। जय 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 Hi, welcome back. So we can now continue with our discussion on the auditor's report. Moving on to the next section. In this particular audit report, there were certain other matters, right? But these other matters, there's a separate discussion and another auditing standard. So that's why I would request all of you to please skip this particular section for the time being. I'm not really getting onto this particular section. After this section, the auditor is required to report on other legal and regulatory requirements. So it's all about other responsibilities of the auditor, other reporting requirements of the auditor. So let's try to understand what are these. And through these reporting responsibilities, some of the other reports which the auditor will be commenting on will also be getting covered. So let's read through this part. Our opinion, as required by the company's auditor's report order 2016 issued by the government under this section so and so, a statement on the matters specified in para 3 and 4 of the order for the company to the extent applicable has been given. So now the auditor is giving the reference of CARO, and he is saying that after this report you will also find CARO. So let's see how will this CARO be given over here. So we are just continuing with this report. So this is where the audit report ends, and then the report on CARO starts. Can you see this? Annexure A to the auditor's report. This annexure A is the reference, or the reference of this annexure is given in the main report by the auditor. And this annexure is what? This is the CARO report. Clear? So this is how CARO report will be referred to in the main report. Number 1. Number 2, 2A. As required by section 143 of the Companies Act, based on our audit and consideration of various other points, we report to the extent applicable that. So let's see what are these reportings which he is doing now. Now, these are certain specific points on which the auditor is required to report on, as per the requirements of that particular section of the Companies Act. A. We have sought and obtained all the information and explanations which, to the best of our knowledge and belief, were necessary for the purpose of our audit. So it's a specific declaration sort of thing which is required to be given in the report, which anyways the auditor would have done, but is now required to specifically comment on this point. In our opinion, proper books of accounts as required by law have been kept by the company and its joint operations so far as it appears from our examination and the report of the other auditor. The standalone balance sheet, P&L, cash flows, statement of changes in equity are in agreement with the relevant books of accounts. Means the books of accounts which the company has maintained, they have become the basis for preparation of these financial statements. In our opinion, aforesaid financial statements comply with Ind AS, means the relevant gap. So in this case, the relevant gap would have been Ind AS. Next, on the basis of the written representations received, point number E, from the directors as at 31st March 2020, taken on record by the board of directors and the report of the state, none of the directors of the company or this joint operation is disqualified as at 31st March 2020 from being appointed as director in terms of section 164 subsection 2 of the Act. Okay. Next, with respect to the adequacy of the internal financial controls with reference to the financial statements of the company, because where is this control etc. required to be assessed? The only one place, that is in respect to the financial reporting. So the auditor is saying, with respect to the adequacy of all of these controls with reference to the financial statements of the company, yeah, and the operating effectiveness of such controls, refer to our report in Annexure B. Now, what is this report? There is another report for which another annexure has been given, and this report is nothing but the report on IFC. So let's see how will this report be given by the auditor. So after the main report, Caro report starts. Okay, this was the Caro report we discussed. This is where the Caro report ends, and after the Caro report comes the Annexure B to the independent auditor's report, and this is nothing but the report on IFC, and which has been referred to in the main report. Clear on this? Yeah. So this is how all of these reports will come. Next, point number B. With respect to other matters to be included in the auditor's report, in our opinion and to the best of our information and according to the explanations and based on the consideration of report of other auditors, which was the case over here, the standalone financial statements disclose the impact of the pending litigations as at 31st March 2020 on the financial position of the company. Now, this is again a specific sort of declaration which is required to be given by the auditor. He is required to comment specifically on these points. One is on the impact of pending litigations and whether those have been given in the financial statements or not. Second, provision has been made in the standalone financial statements as required by the applicable, as required under the applicable law and Ind AS for material foreseeable losses on the long-term contracts, including derivative contracts. And for this, if there is any reference of the notes to accounts, auditor is giving that. He is saying refer note 53rd to the standalone financial statements. Therein you will see this disclosure. This disclosures in the standalone financial statements regarding holdings as well as dealings in specified bank notes during the period, this is the specified period, have been made in the financial statements since they do not pertain to the financial year ended 31st March 2020. Okay, so this disclosure was required to be included in the financial statements in the year of demonetization. Since then, the reporting requirement in relation to this has not been changed. So till the time it is not changed, auditor will have to just keep commenting on this. Okay. Next, point number C. With respect to the matter to be included in the auditor's report under section 197, subsection 16, he is saying we draw your attention to note 45 to the standalone financial statements, according to which managerial remuneration paid to the CEO and to the managing director of the company amounting to so and so for the financial year exceeds the prescribed limits under section of the Companies Act. This amount excludes performance and long-term incentives, which will be accrued post determination and approval by nomination will therefore also exceed. So if the amount excluding that is exceeding, then when you add these amounts, that will also exceed the prescribed limits. As per the provisions of the Companies Act, excess remuneration is subject to approval of the shareholders, which the company proposes to obtain in the forthcoming annual general meeting. The Ministry of Corporate Affairs has not prescribed other details under this section of the Companies Act which are required to be commented upon by us. Okay, now the point number C was around the managerial remuneration, whether that is as per the prescribed limits or not. So auditor found some problem in relation to this, so that is also covered over here. Okay. Then comes the end of the report. Now the audit report has to be signed by the auditor. The audit firm, the name of the audit firm, its registration number is required to be specified on the auditor's report. The name of the audit partner, his membership number is required to be specified on the auditor's report. And the audit report has to be duly signed. So if you look at this partner, this is a printed report. This will be duly signed. Okay. The place and the date on which this report has been signed, those are also required to be given. And now a unique code for each and every report which is issued by the auditor is also required to be specified on the auditor's report. Now, what is this UDI? It's a unique identification number. This is generated from the records of the ICAI. Whenever any such report is required to be issued, the auditor will be required to generate this. So it's like a PIN code, it's like a code which is unique. So every time you generate this code, this will be different from the previous one. So it's not something which will keep getting repeated. Yeah. And every attestation document, and of course, report is also an attestation document, needs to carry this UDI. If this UDI is not specified on the auditor's report, then this report is of no use. It's not considered to be a valid report. Okay, this is again a mandatory requirement in relation to the auditor's report. Okay, clear on this? Now I can go to your queries if you have any. So with this, we come to an end to our discussion on the auditor's report. As around the auditor's report, there are few things we have not discussed, and that is all about modifications or certain reporting requirements in the nature of emphasis of matter or other matters. The other matters were specified in this report, but we didn't get into details around it. We didn't understand the concept around it. Correct? But of course, we have looked at the requirements of CAM. That means the key audit matters in this report. Now, all of these sections of the auditor's report that we have discussed, they all flow from the requirements of SA 700, SA 700, and all of these sections that we have discussed are all mandatory. So there's no section which we can say is not mandatory, and hence the auditor may skip that section. All of the reporting requirements that you would have looked at in this auditor's report are all mandatory. So auditor cannot just say that because this particular part was not applicable. Like for example, you saw that specified currency notes. So even though that is not getting disclosed, but still that is required to be commented upon by the auditor in the auditor's report. So all of these things therefore are mandatory, and the order in which you have seen this report is again specified by the auditing standard. So we cannot just take the auditor's responsibility at the beginning, or let's suppose we cannot just take say management responsibility at the beginning, or we cannot just say that first of all we'll give the auditor's responsibility and then the management's responsibility. It has to be in a particular order. Correct? However, one thing which happens to be sort of flexible in the auditor's report is about CAM. So let's see, what do I mean by that flexibility? If you look at all the requirements of the auditor's report, whether it is about opinion, whether it is about basis of opinion, whether it is about management responsibilities, whether it is about auditor's responsibilities, all of these points, they all have got prescribed for me. They have all got prescribed requirements. Each and every line that you read in the auditor's report is prescribed. It's required to be reported upon, which you can't really change, which you can't just do away with. Similar to this, there is a requirement of CAM, which again has to be included, which again has some criteria in terms of their determination, and which require description and which require procedures for those matters. Okay, but what will be the description of the matter and what all procedures are performed by the auditor? These are not prescribed. So we cannot say that for each and every matter certain specified procedures are given. No. We cannot say that for each and every type of matter the description criteria has been given. No. So this is all something which is on the part of the auditor. This is something which the auditor will decide. What all description he has to give, whether he just wants to give this he wants to just get into the details around it, what all procedures he wants to specify around this particular item. Now this is the only part which we can say is sort of flexible in the auditor's report. Otherwise all of these things are sort of standard and fixed. Clear? All of you clear on this? Yeah. So now we will move on to the next part of the audit report in a way by picking up another auditing standard, SA 705. Basically, all of this 700 series is nothing but the auditor's report. It's just that it's been broken into various standards. So that's why, in a way, we are continuing with the requirements of this auditor's report. So moving on to the standard. In the audit report which we discussed, there was one part we did not discuss: modifications. So now we will try to understand what are the modifications, what are the criteria for giving the modifications in the auditor's report. And through our discussions around the modifications, we will also keep getting certain perspectives around the differences between the modifications and CAM. Okay, yeah. So let's try to understand some of the meanings for us to get into the modifications. So what can be a modification? Modification can be a qualification, adverse opinion, or disclaimer of opinion on the financial statements. All of these can be the modifications in the auditor's report in respect of financial statements that are under audit. Clear? Now, before we get on to the modifications and try to understand as to how all of these modifications etc. can come, let us also try to understand the meaning of pervasive, a term used in the context of misstatements to describe the effect on the financial statements of misstatements or the possible effects on the financial statements of misstatements, if any, that are undetected due to inability to obtain sufficient appropriate audit evidence. Pervasive effects on the financial statements are those that, in the judgment of the auditor, are not confined to specific elements, accounts, or items of the financial statements. If so confined, represent or could represent a substantial proportion of the financial statements, or in relation to the disclosures are fundamental to understanding of the users of the financial statements. Okay, with this, I'm not sure whether you would have got complete clarity around this, but still some part I'm assuming you would have understood. So now let's move on to understand what are these modifications, how all of these modifications are required to be assessed. Okay, so let's understand the impact on the financial statements and let's understand what will it result into. So we are saying one is qualified opinion. So we are talking about modifications. One is qualified opinion. Second is adverse opinion. Third is disclaimer. Disclaimer of opinion. When the financial statements are misstated materially, So we are saying financial statements materially misstated. And I'm sure you must be knowing about this materially misstated. Means the misstatements in the financial statements have crossed the materiality threshold and the management is not passing the adjustment entries to correct those misstatements. That is called as material misstatement. Okay. In such a case, qualified opinion will be given. Correct? Let's suppose if the financial statements are materially misstated, but their impact is pervasive. So in this case, we are saying impact is not pervasive. And in this case, we are saying impact is pervasive. Okay, so now we are looking at a couple of situations. Whenever there is a material misstatement in the financial statements, that means it can become a qualified opinion or adverse opinion. It can be either of these two. But out of these two opinions, which opinion needs to be given will be dependent on the fact that such impact is pervasive or not. And let's try to look at few examples to understand this. Say in the financial statements, revenue is misstated. Means correction entries are required for revenue, say for 10 crore rupees. Revenue is inflated by 10 crore. And certain expenses are also shown in excess by say 9 crore. So all in all, net impact on the P&L is what? 1 crore. Now in this case, if we go on to say that the impact of these misstatements is limited only to two captions. One, revenue. Second is to the expense, which has also been increased. But it does not covers entire set of financial statements. It's limited to these two. It doesn't cover entire set of financial statements. Means the financial statements of the company are perfectly all right if we remove the impact of these two, or only in these two items there's an impact, otherwise the financial statements are all fine. Then such an impact, even though it is material, still that will be considered to be not pervasive. Means something which is not covering the financial statements as a whole. It's limited to certain items of the financial statements. Okay. In such a case, which opinion will be given? Qualified opinion. Okay. But let's suppose PPE of the company has got misstatement. It's a material misstatement. And PPE comprises of 80% of the total assets. And because of this, depreciation is also misstated. The company doesn't have significant revenues. In fact, the revenues have just started. It's all expenses, it's all capitalization in the company. So if you look at the balance sheet of the company, the significant chunk of the balance sheet is what? PPE, and that is misstated. The significant part of the P&L is what? Depreciation or the other expenses, and those are also misstated. The disclosures around this PPE, they have also got misstated because of these corrections, and they are all material. So now this is one impact which is not only limited to one item, or even if this is limited to one item, this covers majority of the financial statements. So any impact which flows to entire set of financial statements or which covers majority part of the financial statements will be considered to be not only materially misstated but also pervasive. And the moment the impact become pervasive, what do we call it as? Adverse opinion. In such a situation, which type of opinion will be required to be given? Adverse opinion. Okay, clear on this, all of you? Yeah, in terms of the opinion requirement, what is this pervasive, what is not pervasive? I'm just hoping you would have understood, and in what situation opinion will be qualified and in what situations opinion will not be qualified, but it will go on to the adverse opinion. Okay, clear? Now moving further on to this, let's talk about disclaimer of opinion. What do you mean by disclaimer of opinion? During the course of the audit, auditor would ask for a lot of information in relation to various areas. And on the basis of the information that the auditor would have received, material misstatements may arise. Means only when the auditor will receive the information, he will know whether the information is correct or not, whether the impact of that information is correct or not. Yeah. And therefore, auditor will also have the numbers available to him, which he can compute, or on the basis of which a lot of computations can be done by him, and through which he can comment whether the opinion is required to be modified in the form of qualified or adverse. Correct? Let's suppose the information which the auditor has requested is not made available to him due to any reasons. And in the absence of the information which the auditor would have received, he has got another option of performing alternate procedures. Say the auditor requested for confirmations of the customers. You remember external confirmations we discussed? Correct? So the auditor would send the reminders for the confirmations, then again reminder, then again reminder. What if the confirmation is not received at all from the debtors? You will have to discuss with the management, try to understand all of these things. Yeah. Some of the confirmations which were received, they had differences. And let's suppose because of those differences, adjustment entries are required to be passed, which the management refuses. And those are material. So what will happen? There will be a qualification, or there could be an adverse opinion. But in respect of the confirmations which are not received, can the auditor say that I have not received the confirmations? The answer is no. Why? Because if the confirmation is not received, then the auditor will have to look at other ways to complete the audit, to complete his audit procedures. And what are those other ways? Other ways are to get into alternate procedures of subsequent testing, verification of the contracts with those debtors for whom the confirmations have not been received, collections which would have been received from all of those debtors subsequent to the year end, verification of invoices and various other supporting documents in relation to the sales which would have been made to all of those debtors from whom the confirmations would not have been received. By performing these alternate procedures, auditor will be able to conclude, even though he didn't get the first thing which he wanted, but at least some alternate was available, and which was not beyond, which was not really within the control of the management to provide. So that's why he relied on the alternate procedures and completed the audit, which is okay to understand and which is reasonable in the given circumstances. But what if this alternate procedure also could not get completed? Why? Because the information which the auditor asked in relation to the alternate procedures was also not made available to him. That is also not made available to him. In such a situation, will the auditor be able to complete his audit? No. Now, when the auditor doesn't get the information, can the auditor conclude that he has obtained sufficient appropriate audit evidence in respect of the audit of the financial statements or in respect of audit of that particular area? No. No. Correct? Such a situation may again lead to two consequences. So we are saying in respect of the financial statements, first situation was the one wherein sufficient appropriate audit evidence. Let me just put it over here. We can say sufficient appropriate audit evidence. Okay, in this case was obtained. In this case was obtained. And the auditor concluded this to be materially misstated, this to be materially misstated, this was not pervasive, but this was pervasive. But auditor could do this because of the fact that he could obtain this. Let's suppose he is unable to obtain sufficient appropriate audit evidence. Let's suppose if this is not obtained. Now the question arises that what would the auditor do in this situation? When this is not obtained by the auditor. So what is the course of action in such a situation? What is the course of action in such a situation? In this case, again, what is it that will be required on the part of the auditor? He will now have to again make the assessment that the information which he wanted and the information which is necessary for him to conclude that the audit evidence is sufficient and appropriate, which has not been obtained, what is the possible impact? Now he will not be able to determine the actual impact. Now, what is the possible impact due to non-receipt of that information on the financial statements? If once again he would say that the possible impact due to not receiving the information is material but not pervasive. So once again, what will he do? He will give qualified opinion. Or let me just repeat it. Once again, he says it's material but not pervasive. Not pervasive. So there he will give qualified opinion once again. Why? because information is not received, which has led to material misstatement or which may lead to material misstatement. But at the same time, he understands on the basis of his judgment, on the basis of his procedures, whatever he has applied in terms of reaching this possible conclusion that its impact will not be pervasive. It will not be pervasive. Okay. But let's suppose if he concludes that because of this lack of sufficient appropriate audit evidence, impact will not only be material, but that will also be pervasive, then he will get into disclaimer of opinion. Then he will say this is material and pervasive. Now he will not get into adverse opinion. No. Now he will get into disclaimer of opinion. Disclaimer of opinion is a rare situation in audit. Disclaimer of opinion simply means that the auditor did not receive the evidence enough to perform his audit. Forget about the conclusion of audit. Forget about the opinion on the financial statements. Audit could not get completed. So if the audit could not get completed, can the auditor's opinion? Not at all. In both these cases, auditor was able to give his opinion. Whether it was leading to misstatement or not. But it's a very difficult situation for the management and auditor to handle. And that's why you will see this situation rare. Because in this situation, effectively, what is the auditor saying? That he has not really performed an audit, or he could not really perform the audit. Okay, clear on this? Yeah. So what we can do now is, we can look at some examples of the auditor's report. And through the examples of those auditor's report, we will try to understand as to how these things are really reported in the auditor's report and how these actually change in terms of the language. Okay, and let me just pull out some of the auditor's report in respect of these matters. Okay, so moving on to this report, let's understand this one. This is the format of the report wherein qualified opinion has been given. Okay, whenever qualified opinion is given, so instead of opinion, if you remember, the header will now change. What will the header become or the subhead become? Qualified opinion. Okay, and let's read the para to understand what is this qualification and how is this qualification conveyed. Auditor will say, we have audited the financial statement so and so, so and so. Right? Then he reads, in our opinion and to the best of our information and the explanations given to us, except for the effects of the matters described in basis for qualified opinion section of our report. The aforesaid financial statements give the information required by the Companies Act in the manner so required and give a true and fair view in conformity with accounting principles. And you may be thinking, but sir, this is a true and fair view. That's correct. Qualification doesn't mean that the whole set of financial statements are qualified. No. What did we understand by qualification? qualification means only a part of the financial statements is misstated. And that's why, what is the auditor saying? Except for the effects of those matters which are described in basis for qualified opinion, everything is fine. So he's saying, except for PP, except for revenue, except for expenses, everything is okay in the financial statements. So he's giving a true and fair view, but some part he's not clarifying, some part he is not clearing. Yeah. Then the next section will flow, wherein the basis for qualified opinion will come. And you can just read this point. Yeah. And you can just also look at the header. Okay. Now the header has changed. It's called as basis for qualified opinion. Clear? Now in this para, auditor would have explained what all have resulted in the qualification. Okay. Now I'll take you to another reports format. Now we will move on to this report. This report contains adverse opinion. Now once again, if you look at the subhead, this is not opinion, this is not qualified opinion. What are they writing? Adverse opinion. And now let's see how the language of the report will change. Now please remember, adverse opinion means that the financial statements as a whole are misstated because the impact has been pervasive. Now in this situation, will the auditor be able to give true and fair view on the financial statements? No. Unlike which he did in case of qualified opinion. So let's read this paragraph. Very, very important for your understanding. We have audited the accompanying financial statements of the company. Okay. In our opinion, next para. In our opinion, and to the best of our information and according to the explanations given to us, because of the significance of the matter discussed in basis for adverse opinion section. So he's saying, I have discussed the significance of a matter in another section of my report. Because of that matter, the accompanying financial statements do not give true and fair view in conformity with the requirements of the applicable laws. Now, please try to compare these two reports. The report wherein qualification is given and the report, this one, wherein adverse opinion is given. In case of a qualified report, true and fair view has come on the financial statements, but subject to certain areas, except for certain areas. Whereas in case of adverse opinion, true and fair view has gone away. True and fair view has not come at all. Correct? True and fair view has not come at all. Correct? Yeah. And then the next section will come, which will explain the basis for this opinion. And there the auditor will again discuss the matter. So for us, discussion of this matter is not important. For us, the understanding is important. That what do we mean by this qualified opinion? What do we mean by adverse opinion? And what is the consequence of these opinions on the financial statements? And how is that consequence reflected in the auditor's report? Can you now understand these differences more clearly? Yeah? Clear? Okay. Now I will take you to another auditor's report for disclaimer of opinion. And we will now see as to how the language of auditor's report will change over there. Okay. Yes. So let's see. One of the most serious forms of reporting in the auditor's report in the form of disclaimer of opinion. In both the reports, means the one wherein qualified opinion was given and the one wherein adverse opinion was given. What was the starting part by the auditor? If I read the language once again for your purposes, those reports read as, we have audited the accompanying financial statements. Remember, in both the reports, a line was written, we have audited. In case of adverse opinion also, auditor used the same language, we have audited. Okay. Now let's see in case of disclaimer, what is it that the auditor will write? Auditor is saying, we were engaged to audit. Oh, so that means auditor is not saying we have audited. He is talking about his engagement letter now. He is saying we were engaged to audit the accompanying financial statements, which comprise the balance sheet, P&L, and the cash flows, etc., including a summary of significant accounting policies. So he has not been saying that we have audited. Why? Because the audit could not get completed. How can he say we have audited? It's like we were engaged. Now, he is saying we do not express an opinion on the accompanying financial statements because of the significance of the matter which is described in basis for disclaimer of opinion section of our report. We have not been able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion on these financial statements. Can you now understand the consequence? And can you now understand the difference between all of them? Yeah. So for your purposes, I'll also put it down on the board now. And I'm just hoping that you would have noted this chart. This would be helpful to all of you in terms of your determination of various types of impact which may arise. So let's see. How did the language change? In this case, auditor used the wording in his auditor's report. We have audited we have audited financial statements. Okay, here again, auditor said we have audited financial statements. If you want, you can also note it down for the purposes of the reference. But in this case, auditor is not writing we have audited. Auditor is saying we were engaged to audit financial statements. So you can just see it's a very, very diluted form. The audit is completely gone off. Nowhere he is saying that we have audited. No. So audit is gone out of the purview at all. Secondly, in this case, auditor is giving a true and fair view. Auditor is giving a true and fair view on the financial statements, except for certain items which are materially misstated. But in this case, auditor is not giving a true and fair view. Okay. In this case, auditor is giving his opinion, but he is not giving true and fair view. In the third case, it's the worst situation. Auditor is not even giving his opinion. Forget true and fair view. Auditor is not giving his opinion. Why? Because he's saying, I don't have the information. I don't have the information to express my opinion. How can I comment about true and fair view at all? My opinion is not there. So the opinion is missing. So is there any use of such type of audit? Not really. So that's why this is considered to be a very, very serious matter for the company. And you will see this rare. Adverse opinion is also not something which you will find in the normal course. Qualifications are quite a lot. Qualifications you will generally get to see in the financial statements. But adverse opinion and disclaimer of opinion are rare. Because if these two are given, then the reliability on the financial statements cannot be established. Cannot be established at all. Because who will rely on the financial statements when the auditor is saying that those are materially misstated as a whole? And in fact, in this case, nothing can be commented on that financial statements as a whole. Correct? However, this part wherein the qualification is given, even though financial statements contain some misstatements, the user can still make out, okay, all right. So if I put the impact which has been mentioned in the qualification, yeah, I can just rely on these set of financial statements. But still, whenever you see any sort of modification in the auditor's report, the reliability of the users, the comfort level of the users in respect of that particular entity goes down very, very significantly. That's why whenever there is any sort of modification or reporting by the auditor in the auditor's report, that is very significantly resisted by the management. Management would generally not like to accept any sort of modifications in the auditor's report. Clear? All of you clear on this? In respect of three types of modifications which are possible, and I would not say disclaimer is actually a modification. It's like not including anything at all in the form of auditor's report. Yeah. All right. So with this, we have discussed about this modifications in the form of SA 705. Other than SA 705, we have got another SA 706, which is talking about two situations: emphasis of matter and other matters paragraph. Other matter paragraph was the one which you saw in the audit report that we discussed. So in the next session, we will have a discussion on both of those points, and with respect to some other points related to the auditor's report in the form of SA 710 and 720. As of now, what we can do is we can just end our discussion over here, and if you have any questions around any of these points, we can have a discussion on those queries as well. Yeah, but please remember that audit report happens to be a very, very important area for you, and also I understand from the examination perspective. So just make sure that whatever we have been discussing in the class, you practice that in the form of examples and just go through that. We will also pick up examples based on all of these types of reports and all of these essays in one go. Yeah. So once we are done with this emphasis of matter and with other types of reporting requirements, we'll also pick up some examples to discuss all of these situations, because all of them happen to be sort of interrelated to each other. So that's why it's the best way to start once we are done with it. Okay. Yeah. And you will be able to understand that and answer those if you only revise this. All right. Clear? So with this, we come to an end to our discussion today. And as regards your queries on the video, as I told you, all of these things will be sorted out very soon, because the process is all going on. So don't worry about it. Yeah. So thanks to all of you once again for your time and for your wonderful participation. Sumit is asking, disclaimer means the warning. So Sumit, we discussed significantly about disclaimer. It's not really warning. It's about the conclusion. It's about the final outcome which the auditor has given, that he has not been able to audit. So it's not a warning at all. Yeah, warning means I'm warning the management that please provide this. It's not warning. It's about conclusion. It's final reporting. So we are all discussing about the final reporting. These are not warnings. But of course, for a company, it's a very, very serious matter. All right. Yeah. So once again, thanks so much.